They will do anything to fund the government. That's the bottom line. We're too far down the road. Now it's Weimar America, baby.
Dance while the music's playing and the Fed's cutting interest rates at 4% unemployment and rising inflation.
Now the play is to speculate on, do they go 25 or 50? I haven't seen many people start to talk about 50 yet.
The system is so screwed. It's unreal. If we have a recession, the deficit goes to bazillion and we become a third world country. The best way to get out of this is...
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. The Blockworks Digital Asset Summit, crypto's premier institutional event, is back in London this October 13th to 15th. You've got top speakers from BlackRock, Circle, Coinbase, the UK Parliament, and Athena, all under one roof. I'll be there as well, hosting a live forward guidance episode with Quinn and a few others. So if you want to see us record in the flesh or meet some of the other legends from the forward guidance community, this is your shot. Notable macro names like Michael Howell of Cross Border Capital and Jeff Park are already confirmed, with more coming. There's also a VIP dinner on the 13th that will sell out fast. That's for speakers and VIP ticket holders only. It's at Old Billingsgate in London. Use code FORWARD100 for £100 off. See you there. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, what's going on, everybody? Welcome back to another Roundup edition forward guidance. We are coming out of the other end of what was the macro Super Bowl last week. Just an absolute mind-numbing amount of data to parse through. Made it through the other end. Man, I was looking at a chart of September rate cut odds, and it was the most biggest whipsaws ever, man. It was like, what was it? On Wednesday, we got the PCE, and then suddenly it was like 40% odds of a September cut. And then we got the jobs report, which we talked about last week, and then suddenly it's at 90%. I think I was somewhere like 97% now. Big week to say the least. What's going on, guys?
So it's hard to call 1 week that the macro Super Bowl, because every week there's like 4 times per day Trump announcements that have the same effect. So you're just like
more traumatizing events.
Yeah.
Did you see Cuppy's long diatribe?
That was so good.
It's just like, you can't manage money as like a long short investor right now, just because Trump headlines whip us back so badly.
Yeah, dude, you wake up and it's like, all right, what's going to happen today? What's going to happen today? Well, yeah, I mean, like literally yesterday we got the news of forward guidance repeat guest Stephen Miran got nominated to the Federal Reserve Board to replace Adrian Kluger. Pretty important to note that this is temporary, just until the end of her term, which was supposed to be the end of January. So we don't really have a read on what's going to happen after that. But the fact is, yeah, Stephen Miran, he's the chair of the Council of Economic Advisors. He wrote a pretty, I would say, contentious paper back in the fall. We interviewed him about it, discussing potential playbooks for tariffs. Some of the takes have panned out well, some less well. But overall, yeah, now he's at the Fed, which is wild. Like, I don't know. I haven't looked back at history to see like how many, existing like current administration employees have ended up actually in the Fed. I don't know if there's much precedent for that, but here we are.
Dude, pretty soon you're going to be making policy, Felix. You're just going to be this Canadian like inceptor of, hey.
That would be the second Canadian that infiltrated, because the first was Elon.
Exactly.
Yeah. No, every day I go back and forth between like, are all these actions compromising the Fed? Or are we going to look back in 2 months or 3 months or 6 months or whatever, or 12, whatever it is, if inflation is back and the Fed doesn't do what Trump wants and there's a battle, and it's like, we all look back and it's like, well, duh, like no crap. These people aren't cutting again when inflation's back above 3 and unemployment's still at 4.2. And I don't know. I think maybe you're supposed to just, dance while the music's playing and the Fed's cutting interest rates at 4% unemployment and rising inflation again. But it's an interesting paradox.
Dude, just change your framework. If they will do anything to fund the government, that's the bottom line. Markets are a political decision, and I think I had this argument with Danny Dyan, a month or two ago, and he was like, "No fucking way they cut rates." And here we are, 91%. Not to call him out, but like 91% chance of an ease in September, and it's just they're gonna finance the government. It's tale as old as time. That's just what's going to happen. And they'll figure out the political tools to do it. Even if Trump's like, hey, we're going to release the Strategic Petroleum Reserve. And also we're going to unlock, 100 million, things of barrels of oil in Antarctica. Like they'll do anything to get prices down. So that's my read.
I think most people agree with that. It's just a matter of like, do they do that when stocks are at the valuations they're at, or do they save those tricks for?
I feel like we're just having a repeat of last summer. Like,
yeah, it does feel like last summer a lot.
Dude, like it's crazy. It's funny to think about like what we were talking about last summer. It's the exact same situation, slight differences in the labor market, but it's like, okay, we got a labor market scare that freaked everybody out, but this time it's being driven more so by just terrible revisions, basically negative prints and payrolls, while the unemployment rate stays pretty solid. Last summer was the opposite situation where we saw the unemployment rate surge, but payrolls were somewhat okay. I mean, I would almost make the argument that we're in a worse situation right now from a labor market perspective than last summer. Because like last summer, jolts were okay. Like, yeah, we were chilling. Initial claims were in the dumps, which they kind of are now. But continuing claims, like we hit a new cycle high there. So, I mean, when you look at just the composition of all the data points, yeah, I'd make the argument we're even in a worse situation than when they cut 50 last September. And so here we are again, right? Like we had the July meeting. Now we have this Jackson Hole Symposium thing in August, which is oftentimes just seems like this pivot point that Powell likes to use. Obviously, the market's starting to front run this. We're at 97% odds of a rate cut in September. I don't know. I feel like now the play is to speculate on, do they go 25 or 50? I haven't seen many people start to talk about 50 yet. I know Anna Wong started to speculate on it in some of her research, looking at just what is likely in terms of revisions coming up in the next couple months. But I don't know. Yeah, it feels like Groundhog Day. It feels like we're right back where we were last summer.
The difference is that rates are 100 basis points lower and not much closer to inflation, though. If we're using that analogy, and
yeah, but growth is lower too.
Yeah, it's funny that Miran was one of a very vocal critic of the Fed intervention last fall, but he argues that the supply side policies that are loosening up housing and other things to bring prices down and whatnot that the government's doing make Fed cuts here the right move. But yeah, it's a very interesting because I have a hard time buying. I do think the labor market's weaker, but I have a hard time buying that it's going to fall off a cliff here. And I think bias should be towards the continued very, very gradual deterioration like we've seen, which means, the scare from last Friday might have been, overdone a bit when it comes
I sort
to
of feel like it was
things.
a climax moment. Like labor market lags everything. And so we had all this uncertainty for months around tariffs. So it's like, of course, yeah, nobody's going to hire right now. I don't know. I mean, soft data is picking up. It feels like that was sort of the flush of the recession fear. I don't know. I'm sort of tilted towards we are rebounding from here on, but I don't know what you guys think.
I think there's two different economies. There's a depression economy, if you look at commercial real estate, and then there's the secularly growing CapEx cycle of AI and hyperscalers and fiscal spending in defense. And I think those two worlds are, it's so hard to address. It's like the central banking blunt tool of interest rates will always bail out commercial real estate, and because that's where all the life insurance money and the pension endowment funds are. They're gonna lower rates because those public incentives need to be bailed out. Otherwise, the boomers will go crazy. It's the boomer world, and then there's the frontier world. That's the way I see things. And this is what I meant by the short volatility assets and the long volatility assets is like, no matter what, fiat dilution is going to flee into the long volatility assets. And this is the exact thing that would happen. It's like, and I want to go through, if you guys care if I go through some of these tweets from one guy. So I got to give a shout out. This guy, Nightingale Associates, puts out absolute fire. You got to go give him a follow. So he says he basically does all the transactions in commercial real estate around the country. And this is going to take a little while, but this is fantastic. The 52-story Wells Fargo Center in Denver, Colorado is recently praised at $115 million, a 76% drop from its 2019 valuation. More than 1 million square feet building backs a $277 million single asset CMBS deal, and the downgrade has already triggered partial interest payout cuts for holders at the top tranche. Bondholders that bought what was once a AAA bond now face roughly $22 million in implied losses. Lower tier notes are trading for pennies on the dollar, with some likely to be wiped out entirely. Brookfield bought the tower in 2020, but defaulted and walked away in 2023. Downtown Denver's office vacancy currently sits at 36.8%. And then if you go to the next slide, this is crazy to me. All right. Portland, Oregon, downtown real estate fire sales will hasten millions of property tax losses. The sale of Big Pink and other prominent buildings will ripple across Portland's central city, triggering potential reevaluations of other office buildings' tax bills. Multnomah County, like any appraiser, uses sales of comp properties to judge the value of those not recently on the market. Big Pink last month sold to Nevada auto magnate Jeff Swickard for $45 million, shedding $327.5 million in value compared to its last sale. I mean, these numbers are absolutely incredible. It's like all of a sudden, the boomer cycle of, let's take premiums in, let's take tuitions in at our endowment, and then we're going to go buy these buildings and we'll rent them out and it's stable income. And then bam, nailed 76% drawdown. I mean, this is like Thanksgiving dinner for a turkey where you get them all fat and then just chop them up. I mean, it's the, the black swan thing that's going on here. And let's keep going. This, and I'm going to talk about how this all nails like the public finances too. So bonds of junk-rated cash-strapped Chicago, Illinois school district continue to lower as the district must figure out how to close a $734 million deficit in the next few days. The district is the largest muni junk bond issuer by par amount since 2000. It has about $9.3 billion in outstanding debt. So it's trading, these muni bonds are trading at 85 cents of the dollar, which is like wild. I mean, for muni bonds. And then this is the best part. So Chicago is just an absolute shit show. Chicago's facing a $1.12 billion shortfall. This is the next slide. The CTA, Metra, and PACE face a $770 million mass transit funding shortfall. Chicago Public Schools must find a way to erase that $734 million budget shortfall in the next few days. The new pension law sweetening the pensions of police and firefighters is expected to add more than $11.6 billion to Chicago's $36.5 billion long-term net pension liability. So they're sending more money to the police and firefighter pensions. Funded ratios of the police officers and firefighter pension funds are expected to drop to 18% from about 25%. Okay, so first off, I mean, you wonder why there's a bull market. This is the snake eating its own tail, the Ouroboros, if you will. So, so all the buildings are falling in value. Then there's less taxes coming to the state, right? In generally the blue states, especially Portland, Portland, Oregon, and Chicago are like ground zero for this stuff. So less tax dollars go to the state. But at the same time, they have to make up the public pension funding gap. So they have to raise the allocation of taxes to go to fund the pensions, to buy more debt, to buy more yields of boomer bonds that goes back into buying high yield bonds or buying the exact assets that are taking a 75% haircut. It's mind boggling. I mean, when you think about it, and then this is the best part. This is on the second slide. Mayor Britt, go back. Mayor Brandon Johnson sounded the alarm, saying Chicago, Illinois is at the point of no return in a quest for new revenue to address structural budget problems, mounting pension debt, and funding shortages for transportation and education. I mean, like, I'm laughing, but this is actually like, this is frightening. Like, this is, I don't even know how to say it, because this is really affects people's lives. And what they're going to do is they're going to tax the rich, and the rich are going to say, see you later, I'm out of here. And it's these cities are going to turn into like, I don't know. I don't even know what happens in the situation. It's just, it's so terribly bad for society. And like, this is where governance actually matters. In Texas, I think there's a $30 billion surplus. You know, we have people coming here, and you have to compete for taxpayers. At the end of the day, like, if you turn communist, you know, there's effects, and your school systems are screwed. Your public service, like the teachers and firefighters, yeah, like, my heart goes out to these people, because they're, the next generation is screwed. And this is ground zero for all the problems. I'm ranting right now, and it's so crazy to me. But this is also the reason why they're going to lower rates. These problems are so fucking big. It's impossible. So the funniest thing is, like, when they increase the amount of taxes going to the pensions because they're unfunded, that one is just like, they're gonna have to buy crypto. Like, I believe they're gonna have. You can't buy a high yield bond at 6%. You're gonna have to buy it Stretch. You're gonna buy MicroStrategy.
Yeah, they're just send them your bags, Tyler, and that's what they're buying. Rocket Labs.
Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Maybe I'm crazy. Okay, someone in the comments needs to roast me on this and tell me why I'm wrong. But like, the system is just, it's failing. It's absolutely, and maybe I'm wrong. Maybe insurance works, but to me, no. If you follow the daisy chain, unless you're in a state that's growing,
so can that commercial? So I guess that commercial real estate problem, like, can't happen to housing because of the commercial stuff's on 5-year paper and housing's on 30. Is that the biggest difference then?
I actually don't know. This is why we should have an expert on. I'm just talking very superficially, because I could be completely off.
Yeah, the states are like, yeah, it's
so one of this, you'll love this. I did this years ago. You know, I interviewed some guy who was like, Illinois' pension. This is when I was at Real Vision. He was like a pension. He was a chairman of a pension in Illinois. And I was just asking him how it works. And I kept going back. I was like, inevitably you end up like, this is, the numbers don't work here. And he was like, yeah, we're just going to keep buying paper.
Dude, that like, unfunded pension stuff, that, like, I remember Raul had like a long documentary on it too. Like, it hasn't been solved. And now they're just, if anything, it's probably going to get worse. Cause, you know, if you adopt this framework of like financial repression that gets talked about a lot of that is like force feeding just like bonds that are underperforming inflation into institutional places where you can regulate that, i.e. pension funds. So it's like, all right, let's stuff them with bonds that are yielding 3%, I don't know, in a world that has a 5% inflation rate. Like, yeah, what does that do for people?
It's 18% funded with all-time high valuations, allocations to risk assets, allocations to private equity. Like,
dude, these guys were buying the Austrian 100-year bond at negative yield. Like, that's what's hilarious is U.S. pensioners would yield back when there was negative real yields in like 2021.
And then they lost on the dollar since then, probably too.
You lost 40%, and those Vanguard bought these things in your pension that you don't realize you own. It's down, and all these retirees have no idea they own it. The system is so screwed. It's unreal. And
At least
that's
it's not like
why
the Canadian pensions where the
I
Quebec
abhor it.
pension fund owned Celsius that like got zeroed out.
Yeah,
Like, what is a Quebec pension fund doing buying Celsius?
I don't know, but bring this full circle, I really think this is why Trump opened up the 401k system for crypto investment, private equity, real estate, is because you just need the end result of all this is you can be bearish as hell. You see these and you expect there to be like write downs, and it's like it's a self-reflexive cycle of deflation. You tax the rich and it leaves, but what they're not compensating is like, and Quinn, we talked about this off camera, the government has to dilute the currency to keep this thing going, and there's only an off ramp of these other assets that are growing light years faster. So that's why there's two systems. That's what I mean. Like, they're gonna lower rates because this system is where all the pensioners are. This system is where all the boomers have their money invested. So like, everyone's calling crypto a bubble, but they won't even address the fact that, most of their pensions own some of these buildings in Chicago and New York and wherever. It's kind of scary.
I had a similar thing this week. I should have put it in the chart book, but Costco and Walmart trade at 42, I think, and 35 times price to earnings. And they have historical revenue growth of 0 to 3% per year. And they have profit margins of 2 to 3%. And they trade at like NVIDIA multiples. So that's just a sign of just how the 401k thing. Yeah, the 401k thing rubs everybody the wrong way though, because it feels like it's a private equity pay to play dump their bags on retail, like everything is, I guess. But
everything is. There's one last chart I wanted to go to on that. So like that guy, the mayor of Chicago, is like, yeah, we got to raise taxes on the rich. This is where it gets even scarier. Because of the centralization, and we bailed out rich people for like 17 years straight with,
it's a good point.
Yeah. They've gotten so asymmetrically wealthier that they've become increasingly the largest part of consumption. So if you start doing the redistribution policies, that will cause a recession real fast.
I fully agree. Yeah, like, which is so crazy because like the traditional economics is like the marginal propensity to consume is much stronger for those lower incomes. Yeah, but they've just been so whacked, especially by like inflation, et cetera. Meanwhile, it's these the top income earners are the ones that have a bunch of money in money market funds, and that's now earning 4.5%, right? Like that is, they take that and they recycle it. Yeah, like that is a huge outlier risk, I think.
This is explicitly why you can't rebalance the economy and everybody win. This chart is explicitly why, because it has gotten so bad that a rebalancing of the economy has to take place via bad real returns. It could take place with bad nominal, and that's more depression style, or it can also take place with high inflation and low real, but it cannot be, the pie just grows in perpetuity exponentially. It has to come at the loss of another group. It's class warfare.
Yeah, we're in class warfare now. And I just think, I tweeted, some guys were calling me hypocritical. I had this tweet where it was like, central bankers at the end of the day, they've bailed out asset owners for, almost 20 years now. And they'll never actually say, we can't actually give the middle class direct money like we do to asset owners because it would cause this massive inflation and the bond market would blow up. And that's like, and my joke was, 100 years ago, if you tried some shit like this, whoever was the central banker would just be like crucified, because guys actually had testosterone back then, and they would go just be like, you're not taking my money. I'm going to kill you. But now there's internet porn and technology that keeps us busy on like, oh, I'm gonna scroll on Instagram, and no one gives a shit. They just slowly, it's like a frog boiling in water.
Good times for 8 weak men, Tyler.
Yeah, all right.
There you go.
I'm half joking. This is good content, but like really,
Good,
in one
makes
guy.
good clips.
Well, and I said, we're so far along in the cycle, you can't actually just redistribute from the rich. Like the communist Mamdani stuff, I am like so against that. I'm a free market capitalist at heart, but I also know that like the best way to get out of this is you need to actually like give the next generation like benefits now. Like you need to, like he's talking about capital gains for homes tax, going away. There has to be an annihilation of public. The pendulum needs to swim from public incentive to private incentives if you want to grow nominally out of this thing. So my point was, I was like, no tax-free childcare, tax-free, home, tax-free. I was like, tax-free groceries. And he goes, tax-free. Some guy responded, tax-free groceries. You're the communist. And I was like, I know that sounds so hypocritical. But I'm like, it's either that or, if you actually reset the economy with free markets, it would be pandemonium. And I would say I would be for it and just take pain for 10 years. But like, we're too far down the road. Now it's Weimar America, baby.
Yeah, nobody else would do that. All right, I want to shift into something that I want to game out with you guys.
Can I put my muzzle on? That was a good transition.
Yeah. Let's get into some real market stuff.
Shut this guy up. Go get your muzzle.
He said Ponzi 3 times. He's cut. I want to talk a little bit about tariffs again and just game out like what could happen from here on out, because here we are, effective tariff rate, back around 15-17%. Like you can see where we've been. So we had Trump come in. We moved from that like 2.5 or whatever all the way up to 27 at one point. Then we had Liberation Day. That's where that hit. Then we had the reversal of it back down to like 7. We're now sitting at around 17%. And I think they're pretty committed to be able to keep it at somewhere around that level if they can. Now, the situation is that we have this hearing coming up on terms of, are these tariff implementations legal or not? So this is interesting. So it went through the first round at the Court of Appeals, where they basically started to make the arguments about whether they can basically enforce tariffs through executive action as opposed to congressional oversight. And so I'll just read this real quickly. But Thursday's hearing was held before the Federal Circuit's entire slate of 11 active judges instead of a typical 3-judge panel, meaning the ruling can immediately be appealed to the Supreme Court. 3 of the judges were appointed by Republican presidents and 8 by Democrats. Thomas Berry, director of the Cato Institute Robert Levy Center for Constitutional Studies, who attended the hearing, said several judges appeared skeptical of the government's argument that broad terms in IEEPA allowing the president to regulate importation should be read to allow Trump to unilaterally impose tariffs. So a lot of legal speak there, but basically they're laying the groundwork for this to go to the Supreme Court. And then we will get the understanding of whether these tariffs are allowed or not. If they're struck down, all the tariffs that have been collected so far will have to be reimbursed. That's one of these effects. But then also there's this dynamic, and interviewed Anthony Costin this week, and he was talking about just the interplay between the big, beautiful bill being stimulative, but that being offset by tariff revenues as they stand right now. And it's sort of modestly contractive once you add the two together, if we assume the tariff level we're at right now. So, okay, with all that said, I want to game out with you guys. What would happen if this gets overturned? Like if basically tariff implementation through how Trump has been doing that, if that gets reversed, they have to reimburse everybody, and now there's no more tariffs. What would happen to markets? Quinn, you want to start? You kind of brought up this idea when we were chatting earlier this week. I want to hear your read and get by.
Yeah. So, I mean, it's initially the impact is they have to refund $100 billion or around there, whatever we're at through August. I think it's around $100 billion. And then the forward outlook subtracts 400-ish billion from the annual budget revenue. And so you're looking at an even greater blowout of the deficits than probably even the you're looking at the CBO numbers basically, or maybe something worse. So the bond market wouldn't like it. And then when you go down the chain, okay, you say higher yields. On the one hand, you could say, well, then dollar would go up. The funny thing is that when people are going to relate, okay, reverse whatever happened to tariffs last time. Okay, no tariffs, stocks up, stocks dollar up. But back then when tariffs were rolled out, it was amidst a broader policy agenda of the Trump administration of essentially austerity. It was with Doge, it was with cuts, it was with balanced budget, and then tariffs were like kind of icing on the cake. And those were all the reasons I was bearish in the first quarter of the year, because they were, like Besson was saying, 3% 10-year, which looking at it now, you're like, nice. But that environment now has pivoted. The backdrop of fiscal has pivoted to blow the deficits outside of all those things. And so I'm not so sure that it would be, I think maybe you'd get a pop in dollar and stocks because people would celebrate no tariffs. But the difference is that we now have an, much worse deficit situation than was contemplated then, as well as stocks back to the levels of, the valuation multiples they're at. So my gut would say yields up. I don't really know short term, but eventually you would expect to see that NASDAQ to like real world economy, small caps rotation come back, which if you look at these charts, it's insane the move that NASDAQ's put in relative to, equal weight and real economy, small caps Dow. You would expect that breadth to kind of widen out the other way as tariffs have obviously,
because the core of the economy would be reaccelerating.
Presumably, they get this huge stimmy check, but the tariffs are regressive. They're hurting the small caps, the low income consumers the hardest, who can't afford the cost hit. So I guess it would be a pop, and I guess it would be a good, you'd presumably see strength. But it's also increased uncertainty. Like, the thing I question is if is it just a big nothing burger? Because to me, the whole time here, the reason that deals started coming through with trade partners was because they kind of knew this was coming. Trump has already tweeted multiple times over the last few weeks. The only thing that could derail this beautiful thing is the radical left judges. He's been tweeting this at the end of his tweets. So it's like he knows something's coming. So I kind of wonder if it's a nothing burger because he just threatens the countries and said, hey, you abide by these trade deals we already struck, you pay the tariffs. Or so you might have some countries that say, fuck you, I'm not paying tariffs. And then you might have some countries that say, okay, we'll listen to your trade deal and pay the tariffs. I don't know. But it doesn't seem like it's a great thing to have more uncertainty. But it's tough. Like, I don't know.
Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHXFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
I think the market would have discounted this already if it was actually a real thing. But clearly, judging from the small caps, we haven't. I agree with Quinn. When you go from certainty to uncertainty, you'd probably get like a massive pop in the VIX. You'd get some bond volatility. You'd get credit spreads widening. You'd get a delevering from that long short hedge fund community. Then everything would be copacetic, and you'd get buybacks, the $1 trillion of buybacks that happen every day. And everyone's shocked when the market just keeps grinding higher because there's an inelastic market and the float just shrinks. And then that would just come back because that's happening in the stocks that are most sensitive to float constriction and that are getting the benefit from all the inflows of, market cap weighted indices. Even if you have, this is not like a black swan thing. I think the black swan thing is when you actually start getting write downs of stuff on bank books, balance sheets, or regional banks. I don't think these policies are probably 1 or 2 weeks repricing, and then it just goes back to the same old thing, is my guess.
I think the big distinction, and he brought that up, Quinn, is just around the dollar and the effect there. Like, I think it's totally bang on that the reason it surged last time was because there was that underlying tailwind of austerity, fiscal retrenchment, which is the opposite now. So yeah, I think we'd see dollar down meaningfully, because suddenly you're like, oh shit, okay, well, if we're only running the big beautiful bill situation and that goes from 7% to 8% fiscal deficit of GDP, like, okay, we're fully back in run it hot territory, like that is, yeah, bad for bonds, agreed.
And then you get the carry trade unwind maybe again, where
exactly, that whole thing. I think the one thing though, it is interesting, because you would think, okay, dollar down, gold probably up, but I sort of feel like there's a risk premium in gold right now associated with just tariff uncertainty. So I feel like you'd actually see a bit of an unwind. You don't agree, Quinn?
I think anything related to tariffs in the market is chewed through. Like, that premium to me would have gotten gold's the only, like, gold's like the asset that I keep. Everything to me comes back to gold. And obviously that has positive read-throughs to Bitcoin as well, but there's a lot higher correlation from Bitcoin to risk asset multiples. And you don't have central banks buying Bitcoin. And so I don't understand how gold is not, I know it's up 30% year to date. So I hate saying this, but I just don't see how it's not higher in 6 to 12 months. And usually when you say that, you get smoked, but
okay.
Strange.
I got another, this is like, to back you up, I got 2 gold things that are kind of interesting.
I thought you were going to, I saw the BAML financial report was titled with gold binge or something today. And I was like, fuck, like, God damn it.
Ready? Hit me. This is slide 40. This is from Kirill Sokolov, 13D Research. Investment demand has been driving the gold market so far this year. Global gold demand rose 3% year over year in 2Q 2025. Investment demand grew 78% year over year in the second quarter. This was driven by 11% year over year increase in bar and coin demand, and the turnaround from 7 tons of ETF outflows to 171 tons of inflow to global ETFs during Q2. But if you can just zoom in on this chart, but you can see, global ETFs have had inflows, and then China gold ETFs are just absolutely ripping too. But then where, at the end, he says, mine supply grew only 1% in Q2. The first half of 2025 actually generated lower production than the first half of 2018. This is despite a 133% increase in the average gold price over 7 years. So they're not digging up more gold, even when the demand is going, and which is really fascinating. And then this is just a game theory thing. I saw it on Twitter. I'm going to Twitter a lot, but go to slide 39. So this is I thought this was really interesting. I'm sure you guys saw this. The Trump admin told us they were looking to acquire Bitcoin with a budget neutral strategy, or they may just have found one. Engineering.
Bro, this is fucking hopium.
I know it's hopium.
This is hope. This is cope.
Cancel this. Yeah. You're done.
Okay. I thought this is fun.
Scratch
to just,
it.
like, run through.
This is a serious discussion forum.
All right, fine. We don't have to talk about this, but this guy basically thinks they're going to revalue gold, short using gold, and then buy Bitcoin.
This guy also probably sitting in his boxers right now eating Fruit Loops.
It's probably me.
Okay. No. You know what this is? Okay, so what we're talking about is that they tariffed gold yesterday, and they surged gold prices. I think it's just a strong arming play on tariff negotiation with Switzerland, because all the gold gets refined in Switzerland. It all comes from Switzerland. That was my read. I mean, maybe there's part of this. What's that? Yeah,
he does make that point in this tweet, but I think you're more likely to get a budget neutral Bitcoin strategic reserve based off a portion of tariffs. Like they just say,
I'll see the Bitcoin reserve when I see the Epstein files.
You're a hater on that, huh?
On which?
The Bitcoin reserve.
I mean, I own Bitcoin, so I there's a difference between talking nonsense for my bags and being reasonable about what the government should do.
I think what they're going to do is issue Bitcoin-backed bonds.
That also is silly.
You don't think so?
We have a military, dude. We don't need to acquire like.
I think that would nuke the dollar. That's the issue.
Yeah, I don't know.
I think it'd be a really bad sign. Like I think it'd be like
the world's
maybe
number
that's
one
the
military
play.
is more powerful than a Bitcoin or gold reserve. That's the end of the story. So all incremental marginal dollars should be spent there. If that's the, anyways. Sidetrack City. Let's get back.
I don't necessarily disagree. It's a fun thought experiment.
Okay, no, I did want to talk a little bit about just the TGA rebuild. So we'll get into the wonky monetary stuff here for a minute here. But okay, so we got the debt ceiling passed, and now all eyes on, okay, now we got to rebuild like $1 trillion in debt issuance against TGA back to where you want to be. And I think initially I was a little bit concerned about just what this could do to liquidity, but so far it's been doing okay. So I'll run through a couple charts here. New York Fed reserve demand elasticity. I think if you spend too much time on Twitter, you will get caught up in a million different things talking about, whether something is breaking in the monetary plumbing side of things. I would recommend everybody, and you can do this, it's like on the New York Fed website, go look at this chart as much as you can every week. Just check it out. Reserve demand elasticity. This is their best look and model into understanding strain in those funding markets. So you can see like 2018 to 2019, the last time we were doing QT, and then we highlight the repo spike crisis and all that stuff that really just ended the whole thing and actually ended up with further rate cuts. You can see what was going on in this model here. It was just, they got down to negative 1.5 before Powell was like, oh shit, got to slam the brakes. So, okay, now we're through, churning away at the TGA rebuild, and no real signs of stress yet. So I think that's just, pretty key, because obviously, you don't really know how this is going to pan out until we get into it. But another way to look at this is 30-year swap spreads. This is just a pretty good way to understand funding constraints as well. And they've been ticking up higher. So that is an improvement in liquidity dynamics overall. You can see like back here, this is when we had the initial talks about SLR reform, which would be deregulation. And you can see swap spreads just surged. And then we sort of had a few different things happen that removed it. Then the Liberation Day, funding rate blow up, basis trade stuff that happened in the bond market. Didn't really like that. And I've been grinding upwards ever since. So things are going okay. Last chart here, just looking at the TGA versus the RRP. So obviously last time in 2023, most of the rebuild in that TGA came from the reverse repo because it's sitting much, much higher. They're able to fund most of it through that. Right now, different story. RRP sitting at about, just under 160-ish. TGA's, what's that?
It's down to 80.
Oh, is it down to 80 now? Okay, this is a little bit stale from Fred then. Okay, so if it's at 80, TGA is at about 350 right now. It needs to get to 850 by the fall. So still a lot to go. And to your point, Quinn, not a lot sitting in the reverse repo. So this has to come from the open market. So I don't know. I think where I'm landing with all of this is that it's not quite as bad as what it could have been so far, but there's still a lot of streams across to get to the other end of this funding cycle. What do you think about all this, Quinn?
Yeah. So the number one thing is that Bessent has been, when Yellen sort of was just jamming, when she was in charge. Yep. Bessent is being much more pointed and careful with issuance. And the underlying things here that you don't see as much in the big picture numbers is, one, they front loaded bills big time in August. So August is fairly light on coupons, and they've front loaded bills in a major way this month, with the probably idea being drain the RRP first. So they have about 300 billion to go. I think the TGA is actually up into the 4s now, and RRP's just the latest numbers on Bloomberg down to like 80. So but September is actually a massive coupons month, and the RRP should be depleted by over the next few weeks. So you're looking at that last like 200 to 300 billion of issuance to not have the RRP available and to also be pretty heavily weighted on the long end. So I think that's a risk factor that's sitting out there in September on the liquidity side that I'm paying attention to.
Can you translate that for me into English? Like,
Basically,
is it? Yeah, I mean that. I mean that genuinely. Yeah.
Yeah. Basically, they ran the TGA in the first half of the year from 850 to, I think it bottomed at 300 or 350 or something.
Okay.
So or 250
liquidity in the system.
That was an added couple hundred, hundreds of billions of liquidity into the economy and markets and bank reserve deposits. And now they have to refill it. And that liquidity has to come from the market. And they've been refilling it via RRP, so it's not coming from the market, and money market funds like that are flush with cash, who are the new buyers of these bills. So the brunt of the refill, I would argue, has not really come yet. It's a September event, really, where they come to market with the heaviest portion of coupons. And then after it's refilled, the rest of the year, they still have, the large debt burden to come to market with. It's not like issuance goes away. It's just this big hump leaves end of September. So I think the worst is ahead in that regard. However, the previous instances of this, the Fed was not cutting rates.
That's what I was going to ask you. Yeah.
And so that is an offset.
So you thread the needle with, theoretically, you buy more short-term paper now when you can before the Fed actually lowers rates in September.
I don't know. Depends how short, because I would argue the 2-year and many outside of 3 month, obviously 3 month, whatever, live, like super front end. But I would argue like the 2 and 5 year don't really have much like room to go lower. Like they're already in the threes, and inflation is expected to come above 3 in the next 6 months. To me, that's the biggest question I'm kind of scratching my head on, is like, the market's kind of pricing in a lot of the stimulus already. And so like for the 2 year to go to 3 from here, if there's a big market off event, like
you basically need a recession.
Yeah. That's kind of like rates really should, like long-term rates outside of the 3-month Fed funds. The Fed funds is like high and will come down probably 100 basis points over the next year. But everything else out the curve is, the 2 years, 75 bips or whatever below the Fed funds right now. So it's not like a cut doesn't help anything but the Fed funds rate, which the market
but it would help. Yeah. So the one thing it would help is that obviously we're in this regime where most of their issuance is bills right now. And so if they're waiting to refill a lot and issue a lot of this in mid-September, obviously, like 25 bips is, we could do the math. I'm not going to try and do it live, but yeah, it'd be a marginal improvement in terms of the interest expense. But I guess the idea is that those will keep rolling. So if they keep getting 100 bips, let's call it, like you're saying, of cuts, that will be an improvement meaningfully directly attributed to the change in Fed funds.
Man, we are in crazy land. Like, is it a possibility that, like, I actually do think that the economic data is going to roll over here and it's going to be worse, but I'm not sure that the market falls. Like,
well, the answer is negative real rates. That's where we're headed. Like, yeah, because like we know the path that the Fed is on. Like, we can call these appointees whatever we want, but we know there's 3 out of the 12 voting governors who are going to be pounding the table for cuts from now until Powell's gone in June. And then in June, we have 4 out of 12, including the chair. And like, I feel that there's still 50 to 100 basis points of cuts before it gets like really when inflation's at, before it gets like where you're violating fiduciary as a Fed member. Like now, Waller and Bowman, and they can all sit there and say, cut rates.
And they're being proven right now. Like, they are decently, like, you can make the case.
Yeah, dude, I don't know though. We're not at the dual mandate. We're at 4% unemployment, and we're at 2. Not at. So according to the dual mandate, as it's written, I don't think so. But anyways, my point is just that, like, you get down to like where you're only barely above the inflation rate. It's a lot harder for these people to be out publicly pounding the table for cuts with a straight face. but maybe that's a next year problem. I don't know.
Yeah, I think the window's now because I do think inflation's going to head higher. Like, and it's going to be a lot more difficult case to make in 12 months for meaningful cuts if PCE is at like 3.5 or something. All of this stuff, it just boils back down to like gold, Bitcoin. I think you can iterate like equities. I don't know. I get pulled in every different direction these days on those. Bonds, I don't have a good read, but that just still feels like the cleanest trade for me.
On bonds, you got to put this one up. This is 44. So this was from Axios this morning. And right amid calls of a bubble, Vanguard is increasing its allocation to a safer corner of the market for its portfolio.
Safer corner, negative returns last 4 years in a row.
Accounting for 70% of its holdings. The increase in bond allocation comes with a warning. Stocks aren't getting enough reward for the risk of holding stocks. With 30% allocation of stocks, the portfolio also leans risk off. 5% of the portfolio is allocated U.S. growth. But like 70% bond allocation, they're increasing it and 8% to long-term treasuries. And I'm just like, I don't get it. Like, it just, please make it make sense. Like this firm is a multi-trillion dollar asset manager that just made money. Like, it's a factory line of just spewing cash into assets. And I don't know, maybe I'm crazy, but they'll be proven right if there's like a horrible recession and you just have to go up in the capital structure. That's possible. But if we have a recession, the deficit goes to bazillion and we become a third world country.
Yeah.
So like, I don't know, wouldn't you rather just keep creating fiscal infrastructure plans and you're in this AI space race? Like, and
If it's up to you, yeah. Eventually it won't be up to them once they crash the real economy too much.
The level of bearishness from the TradFi boomer Gen X community and like calling for owning bonds it makes me like a natural contrarian, and maybe I'm wrong about that, but I don't know. I feel like when you talk to Gen Xers and boomers about, where the market is, no one thinks it makes sense. And I'm just like, it makes complete sense from a political standpoint and a generational standpoint, but like, they can't make sense of why the market keeps going up. And until they do, until they figure out the flow-based market structure, I think it probably keeps going.
Yeah, like bonds are fine for like a trade, I think, but like we're talking about Vanguard here, so it's like long-term holdings, and I don't know, to be talking about 70% of your holdings in fixed income on like that type of time horizon, it's just like insane to me.
Dude, they were the ones, like, if you look up the holders of the Austrian 100-year bond that they bought at like, I think it was like 30 basis points or something, and they're down like 70% on it. I think they still own it on Bloomberg. It's BlackRock and Vanguard are the top holders. So it's just like, you wonder why credit spreads keep getting smushed. And it's because there's a hell of a lot of rich old people out there.
And I guess this is kind of financial repression in action, like depending on how you view Vanguard, but like,
yeah,
I don't know, like this is, you're stuffing people's money that don't think about this stuff into fixed income that underperforms inflation. Like,
yeah, they'd rather lose. They'd rather just play not to lose. And like that, I would too if I was 70 some odd years old. I guess that's the truth. Is like, why?
But at least go into tips. Maybe part of that is tips. I don't know.
Yeah. I don't know the exact breakdown. All I know is that like the relative, I'm not going to save my way to prosperity as a 40-year-old. So like in that product, I'm like, I can't even keep up with the inflation. There's a guy, there's some gem Twitter viral things. Have you seen this where it's like, I got a raise this year? This guy goes, I got a raise this year. You know where all that raise went? It went right into my healthcare premiums, and I actually lost money. I got a raise and I lost money.
I don't know how you Americans do it. The healthcare stuff just seems insane.
But that's not just the like. I mean, my childcare bill went up probably 10% this year.
Yeah, childcare. Yeah,
so
like, you get affected by that one up here.
You gotta. I couldn't put my money in that Vanguard bond product.
Was that because your nanny got deported or what?
It was just we go daycare, and it's just, do you know what it is? There's so many. It's Texas, so all the people from California and New York that couldn't afford anything moves to Texas. So that this is the only place that actually has kids, that people are actually procreating here. So it's creating like a supply and demand imbalance. It's kind of nuts.
Yeah, it's like the slowest moving train wreck ever, really, because people appreciate the Ponzi nature of the system we're in, but I don't think it's still quite appreciated what it means to be printing 6-7% deficits at the peak of the market cycle. Like that to me is the biggest. It is. I can't even. I like have been studying all these different things on it, and I can't even comprehend it. Like what that next 5 years looks like. And
if we get a recession, like literally, like we all forget that CBO does not consider recessions. I mean, we don't actually forget that, but like there's no.
They also, yeah. They also budget for the 10-year interest expense to be like 200 bips below what it actually is in the market. So every year they're like, whoa, the deficit surprised the upside because we paid 200 bips more in interest expense. It's like, wow, it's like maybe you should have used the forward bond curve instead of your like phony 2.5% assumptions.
Yeah. Government math, bro.
Oh yeah, government math. Yeah. Maybe that's another point on that CBO scoring.
Yeah.
All right, guys. I think we can leave it at
Not
there.
in his favor, though.
Yeah, exactly. Good chatting always.
Yeah.
Let's get a little debate going. I always love when we have differing views. I feel like it always makes for a better show. So love it.
Yeah. I just love disagreeing with you guys.
It's the best.
It's helpful.
Keep us honest.
It's helpful.
Yeah.
All right, fellas.
Good stuff.
All right, guys.
Have a good weekend.